Go?
Yeah.
All right, good morning, everyone, and welcome to the investment meeting for October 2012. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everybody. Andy Schaefer, representing Commissioner Kelly.
Barry Dennis, SIS. Joe Alejandro, PBA.
Pat Andrew, PBA.
Chris McGrath, PBA.
Steve Berbilio, LBA.
Chris Martin, CEA.
Michael Palladino, DPA. Bob North, Actuary.
Barry Miller, Comptroller's Office.
Seema Hingorani, Comptroller's Office.
Thad McTee, Controller's Office.
Larry Schloss, Controller's Office.
Justin Holt, Department of Finance.
Jonas Emery, Mayor's Office.
Bob Senskestedt, Pension Fund.
Kevin Holleran, Pension Fund.
Kevin Allen, Pension Fund.
Kathy Martino, Controller's Office.
Evan Nancy, Controller's Office.
Betty Nicole, Controller's Office.
All right, and for the record, the proxy for the SBA.
CEA, Chris Martin, CEA's got the proxy for the SBA.
Just before, I do want to point out one thing. We have, I introduced him at the last meeting, but I believe today is his first official day. So we have Pat Hendry, he's our new chairman of the board this year, and his term will run till next September 30th. So he will be the other face of the PBA on the side of the table. So, second, last Friday, I sent out a proposed amendment to the pilot search process. So I don't want to put it on the record. I mean, I don't want to read it out. I mean, obviously, it's been sent out to all the trustees for their review. And I believe you have some discussion.
Sure, as you mentioned, Joe, we did receive it from the pension fund, thank you. And we're having discussions, and we'll round up and be back to you to discuss it further.
So you'd like to table it until we have all those discussions?
Sounds like a course of action, yes.
All right, so this will be here on the record, but in the meantime, it will be tabled until we have further discussions with the Controller's Office and the relevant staff. All right, okay? All right. So.
Thank you, Joe. One more thing to round off the introductions. Present also, David, introduce yourself.
David Arlick, I'm the public advocates designee on the National Board, observing.
Okay, thank you. Okay, Martin Gantz will be here a little late, so I'd like to just push off doing the monthly performance until it gets here. In the meantime, we can do the education on infrastructure investing, and I'll let Petya introduce her colleague. You can hear before? So, all right. So why don't you sit there?
Thank you. Thank you. Thank you.
So Petya, you might start with just a little, by way of background, you, because I remember we introduced you initially when you came, and then you kind of went away and did some work, which is always good, as well as Evan, and then have the two of you get to know each other and then walk us through the whole thing.
Good morning. Thank you for having us today. I'm Petya Nikolova, started with BAM around 6 months ago. My background is in infrastructure, more than 10 years on different sides of the business, utilities and transportation. And Evan Nansen joined a month ago. Please tell us.
Hello, thanks for having us. Evan Nansen, as Petya said, I also have a background in infrastructure. Did commercial lending for European banks for 7 years. Also have done some municipal finance.
And we have
I'm Ishika from the Townsend Group. I work in infrastructure investments as well as in our advisory business.
Just by way of background, we have, as you all know, we have Townsend as a real estate consultant. Townsend also does infrastructure. So they've been nice enough to help us put this presentation together and slowly work with us to get the infrastructure program off the ground.
So what we're excited to do today is to present to you infrastructure as an asset class and why we think it's a good opportunity to invest in. We are going to go through the different sectors in infrastructure, how we define infrastructure, who the investors are, what the deals look like, and we are also going to go through the investment thesis, again, why it's a good idea to invest in infrastructure, through the different strategies and returns. If you go to page 3 of the presentation, we have a definition there for infrastructure, which is the fundamental facilities and systems serving a community. More importantly, we would like to highlight the characteristics of infrastructure. Infrastructure provides essential services: water, gas, electricity. Infrastructure assets have monopolistic characteristics. There are very high barriers to entry in the sector because these projects are typically very capital intensive. They can be over $1 billion. Another important characteristics of infrastructure assets is that they have a very long life. They may be sometimes over 100 years, and they also present a good match for the liabilities because the assets have such a long life. And finally, they provide predictable and stable cash flows because infrastructure assets are typically contracted or regulated, so we can have a good perspective as to what the cash flows from the asset would look like over a long period of time. With this, I'll turn to Evan to speak about infrastructure.
So I'd like to speak quickly on slide 4 about the ways we characterize infrastructure investments. There's several ways, one of which is by the physical characteristics of the underlying asset, whether it's economic or social in nature. Economic infrastructure are assets for which the end user is willing to or used to paying. And social infrastructure assets are those for which the user is not used to paying. If you flip to slide 5, we have some examples of each. From a risk and return perspective, investments in the in the economic characterization can be found throughout the spectrum. It's typically based on the type of assets underlying the investments and the financial structure used in the investment. For a social infrastructure asset, those are typically at the bottom of the risk-return spectrum, as they have long-term contracts with government off-takers.
Another way to look at infrastructure is as classified by the life cycle of the asset. And essentially, there are two types of assets based on this classification: greenfield and brownfield. The greenfield assets are assets that have construction risk or development risk. They don't generate revenues during the construction period, and based on the nature of the construction and development risk inherited in them, they are just higher risk than the brownfield. For the brownfield assets, these are assets already under operation. So we know well the existing history, the cash flows, so they are much lower risk than the greenfield assets. Just two quick examples: Port of Miami Tunnel, around $1 billion deal in Florida. It's a tunnel that connects downtown Miami with the Port of Miami. That's a greenfield deal, 5-year construction period. It's still under construction, and during this period, the project doesn't generate revenue. An example for a brownfield deal would be the Puerto Rico toll road that was done last year in Puerto Rico, a major artery in the country, around $1 billion, but it has a 40-year operating history. So it's a very different risk profile. And from day one, the project generates revenue.
Can I ask you a question with regards to the Miami deal? do they have a public authority involved with their ports, the airport? And how was that structured?
So the Port of Miami deal, this is under a concession, a 30-year concession with the Florida Department of Transportation. So essentially what happens is, this is what we call an availability deal. So as long as the project is open, available for traffic, and operating under the predetermined standards, they receive a payment from the government. That's the availability payment. So this is the structure for this particular deal. In terms of airports, that's a sector that it's still not very developed in the U.S. Not many airports are privatized. The one in Puerto Rico, territory of the States, was just earlier this year given under a concession to a consortium led by Highstar. If you turn to page 7, you would see a pie chart on the left-hand side illustrating the deal flow in terms of life cycle stage. So what you notice is that the majority of the deals are brownfield deals, around 70% globally, and it's a similar mix in the US. If you look at the pie chart on the right-hand side, it highlights the infrastructure deals by asset type. And the leading sectors are energy and transportation globally as well as in the US. And on the next 4 pages, we have prepared case studies for you. We are not going to go through them today, but if you have any questions later on, we'll be happy to answer. With that, I'll turn to Ishika.
Sure. So we're on slide 12 now. Slide 12 talks about the demand drivers for infrastructure investments. There is both a need and demand for investing in infrastructure. The existing infrastructure in place is more than 50 years old and needs to be replaced. Population and economic growth have created the need to build new infrastructure. And because of budget deficits in the US and Europe, there is a need to look for new sources of capital to fund infrastructure. As a percentage of GDP, infrastructure investments have declined continuously. In the US, infrastructure investments are the lowest when compared to other developed countries. It is estimated that it could cost more than $2 trillion to replace the existing infrastructure. A great example of aging infrastructure is the LaGuardia Airport here in New York. It is estimated that it would cost over $3 billion to make LaGuardia more modern and efficient. Moving to the next slide, slide 13 shows the infrastructure investments required by region. In a recent research report, most infrastructure systems in the U.S. were graded a D or worse. Combination of increased use and increase in population and undercapitalization has created a need to make more investments in infrastructure in both the U.S. and Europe. On slide 14, the pie charts show the infrastructure deals completed historically by region and the capital raised by region. A large majority of the infrastructure deals completed historically have been in the US and Europe. Europe is the largest market for infrastructure deals and accounts for almost close to half of all the infrastructure deals that have been completed globally. In terms of the capital raised in infrastructure, the developed countries of Europe and US account for a majority of the capital that has been raised. On slide 15, we talk about the current market opportunity in the infrastructure sector. The structures for investing in infrastructure are evolving. Public to private partnerships have been slower to materialize. It has been difficult to find deals that have been mutually beneficial to the public sector and the private sector. However, this is a growing area. But in terms of the current market opportunity, the energy sector continues to present the most actionable opportunities in infrastructure. There is a huge need to make new investments in generation, transmission, and renewables. The development of shale gas has created a new enormous opportunity to invest in natural gas transmission and storage. It is believed that the U.S. could become an energy exporter in the next 5 years if all these resources are tapped. Also, state energy policy is driving investment in renewables as more states are adopting renewable portfolio standards. There's also a shift from coal to natural gas as coal plants are being shut down because of regulation. So all these factors make an investment in the energy sector and infrastructure very attractive. Slide 16, there are two major groups of investors investing in infrastructure, direct investors and infrastructure funds. Included in direct investors are some of the largest pension funds in the world, sovereign wealth funds, insurance companies. The investable universe of infrastructure funds has come a really long way since 2005 and 2006, when you could count the number of infrastructure funds on your hands. The market is now more segmented by geography, by sector, and by risk-return profiles. An investor can choose how to invest and where to invest now. Moving to slide 18. The chart on slide 18 shows the infrastructure allocations of some of the largest institutional investors in the world. On average, U.S. pension funds have allocated 2 to 3% of their plans to infrastructure investments. So, slide 19, we talk a little bit about the investment thesis of investing in infrastructure. So why is an investment in infrastructure attractive? Infrastructure investments are attractive because of their ability to diversify a portfolio and provide cash yield. The revenues of infrastructure companies are also long-term, contracted, or regulated and inflation-linked, because of which they are less sensitive to changes in the economy. Infrastructure investments can also be a great fit for long-term investors who are looking for long-term assets to match the long-term liabilities. In the following pages, we show data to validate the investment thesis of infrastructure. On slide 20, and the data on this slide and the following slides comes with a caveat that there is no perfect database that tracks the performance of infrastructure funds. Infrastructure is still in very nascent stages and is more of an emerging asset class. But using the best available data that we have and that Townsend has collected, and Townsend manages over $4 billion in infrastructure allocations on behalf of 10 institutional investors, we can see that infrastructure investments have shown to have a low correlation to other asset classes. When we look at publicly listed infrastructure, we can see if we adjust it, the number on this in this table is high, it's 0.9. But if we adjust it for the financial crisis and go back much longer in time, that number goes down to 0.5. Slide 21 shows that infrastructure in the longer term has shown to generate attractive risk-adjusted returns. In the longer 5-year period, infrastructure has generated a return of 8%. Slide 22, the revenues of infrastructure companies are inflation-linked because infrastructure assets provide a contracted inflation hedge and usually have really long-term regulated contracts that can run for over 20 years. And moving to slide 23, again, I'm not going to spend a lot of time. It just talks about how infrastructure assets have performed better than other asset classes and have survived the crisis well. Even in the most difficult of financial times relative to global equities, infrastructure assets were able to grow earnings. And, well, Petya will talk about the different types of infrastructure investments.
There are different strategies in infrastructure investing, and they have different returns associated with them. The lowest risk strategy is the core strategy, where we have 8 to 11% return. We invest under this strategy in assets that are mature, brownfield assets in OECD countries, the Organization for Economic Cooperation and Development. So we are in well-developed countries, mature assets. If we go back to the Puerto Rican example road, this would be a good asset for this type of strategy, given that it has 40 years of operating history. Another strategy is the value-added strategy. It's still on the lower side of the risk spectrum, but it has room for operational efficiencies. So we are still in mature assets in OECD countries, but we can improve the asset or expand the asset. If we go with the road analogy, we can build a new segment to the road, and this would be a value-added play. And finally, we have the opportunistic strategy, which is the highest risk strategy. And here we can have greenfield development, we can have emerging markets. So we are a little bit further away from the certainty of mature assets and OECD, but we're compensated with a return for taking that risk. And again, using a toll road example, this would be building a completely greenfield road. So we don't have anything in existence, we're just building a new road. We don't know how the traffic would perform. We have projections, but we don't have a history. If you move to page 25, you would see the strategies mapped on the graph. And what you would also notice is that certain assets lend themselves to certain strategies. For example, the regulated utilities or mature social infrastructure is associated typically with the more core strategies. And if you look at the PE-style investments, you would see that the greenfield toll roads and the telecommunications would be associated more with the PE-style strategies. Moving to the next page, 26. That's another risk-return spectrum graph. But here what's interesting is that if you look at on the right side, the upper corner, you'd see power generation that shows returns from 12 to 25%, which is a very wide range. And the reason for that is that although certain assets fall typically under certain strategies, this depends also on the revenue model. So for example, a power plant that has contracted power, we have contracts for 30 years, the risk is lower. We are not taking a commodity risk. For a merchant power, we take that risk, and therefore our return is much higher, could reach 25%. If you move to page 27, we discuss the makeup of the returns. So for the lower risk strategies, big part of the return is made of the income. And for the higher risk strategies, they depend more on the appreciation of the asset. So for the core strategy, the income part maybe is predominantly makes up the return, and for the opportunistic, we may not even have that part. And with this, I'll finish.
So there is no industry standard for benchmarking infrastructure. Most infrastructure investors use the inflation index plus a margin to benchmark their infrastructure portfolios. And this goes back to the point that there is no statistically significant database that tracks the performance of infrastructure funds out there. There are some investors who also use an absolute return target. Most publicly listed infrastructure indices are not a good benchmark for infrastructure because of their sensitivity to public markets. On slide 29, we can see the different ways to access the infrastructure market. Just like in any other asset class, there are 3 different ways that you can access infrastructure: through funds, through co-investments, and direct investments. Infrastructure funds are the most common way to access infrastructure investments. They're also the most efficient, but more expensive than making co-investments or direct investments. Most direct investors invest with funds and then move to direct investments after having built, more diversified portfolio and more expertise and access in the market. Petya will now conclude the presentation.
To conclude the presentation, we hope that we demonstrated to you some of the characteristics of infrastructure that we believe would contribute to diversification and inflation linkage and good risk-adjusted returns to the portfolio. As next steps, we would like to come back with an IPS for infrastructure, recommending pursuing predominantly lower risk strategies, a U.S. global mandate, and a benchmark of CPI plus 4%. Thank you.
Let me just see if I can add a little bit to what Petya just said. If you look on page 27, the different infrastructure strategies, core, value-added, opportunistic, look and sound an awful lot like our real estate investments, core, value-added, opportunistic. And typically, if we're doing an asset allocation, we would all agree you shouldn't do one unless there's 3% that you can allocate, otherwise it's not statistically meaningful. Rather, however, than start with 3% to infrastructure, which takes a while to get to. Since it takes a while to get to, all we would really be doing was setting up an asset class and then worrying about the parking places, which is sort of not a good way to do things. We've got enough parking places as it is. What we'd like to do is take the real estate bucket, make infrastructure, I wouldn't call it a sub-asset class, but put that next to it, call the whole thing real assets. Do some work with Barry, modeling, and then really have the infrastructure IPS be part of a real asset IPS that really is currently the real estate IPS. We might add some other things in there like MLPs or other inflation-related asset classes. But again, since we have Townsend, who's our real estate consultant, also helping us with infrastructure, it just kind of makes sense to start small inside what looks like real estate and gradually work our way into it. Again, they're set up like private equity and real estate funds, which I would tell you is sort of a mismatch with the assets. So you have a 30, 40-year asset, put it in a vehicle that's sort of, 5-year commitment, 5 or 10-year exit, you're not right. Which is why the bigger guys, if you go back to that slide where the Canadians are sort of 20% of their assets are in infrastructure, they own it outright. It goes a little bit to the conversation we had last month or last week about real estate and should we start moving out of just funds and actually own our own buildings or do joint ventures with it. But again, I'm not suggesting we do that for infrastructure quite yet, but it is an asset class that's it's big, it's global, it makes a lot of sense for us to be in, but we have to A, get ourselves in it slowly, B, be very cognizant of the fees, because again, if you're really doing it on what I'll call the non-private equity style, which is try to get low double-digit returns, it doesn't handle very well a 1.5% and 20% carried fee. So you really have to find the right people, very much like our core real estate funds, maybe an evergreen kind of concept or something like that, and slowly work our way into it and see how it evolves. But again, this was the first introduction to the board concept of infrastructure. We think it makes sense.
I just have just a few questions, and I'll probably have more down the road, but you said it's a developing asset class still. It's not, there's no agreed upon benchmark really for this asset class. So as someone sitting on a board, you have to think not only investing in it, but you have to think further down the road, how you get out of it. Are there agreed upon exit strategies with these types of investments? What are kind of the guarantees we have when we get out? of getting, one, a return of our equity and also any return on it. Those are things I have a little concern on. And then, are we going to be displacing potential jobs out of the public sector in some of these asset classes? How do we control that? Once it's out of it goes into this private kind of market, people begin to look at certain efficiencies in their mind and how to save on the investment to make money on it. I'm worried about how do we displace people who are currently working. One example of, and there are abuses of this too, so I'm a little concerned about that. There's a case in there are abuses. There was a case out in Pennsylvania. My understanding was a youthful offender facility was created using public funds, and some judge was sending youthful offenders to this facility and was unfortunately accepting bribes to do so. I have concerns about that. How do we control for that, if we can control for that? Because certain issues can arise where people can abuse that government-sponsored service, obviously for a benefit now, and how do we control that once it's out? So there's a couple little questions I have, but larger questions in terms of strategies, and so I'll just need some answers on that.
Sure, maybe starting with the...
You don't have to answer them all now.
Okay,
I'm going to
great.
get back and forth, but I just want to make sure that, I'm well aware of what the need is, and it's a good idea. I mean, unfortunately, we've had the Minneapolis example where we had a bridge fall down and kill people. So I think we need, obviously, the Civil Engineer Society gave us a D- in this country for our infrastructure. I understand the need to grow our infrastructure so that we can, for the next generation, potentially grow into it. There's little questions before we start asking pension funds to just dole out money to do so, for the short-sightedness of people in administrations who didn't want to take care of that business when they had to. That's my soapbox.
I was going to say, we'll get back to you on that.
Thank you.
I just like to make a couple observations. I think what Larry has laid out is a very good way to proceed, because I think the challenge of infrastructure is not that it doesn't have the right conceptual characteristics. The problem is finding things that will give you the kind of returns you want. The kind of returns on page 27, for example, no offense, although I think their gross expenses are, let's say, optimistic, very optimistic. And so the challenge is to find things that work. There's also, as noted in the presentation, there's now a lot of people who want to do the same thing. And the biggest infrastructure investment failures have been people chasing good ideas and paying too much. And the emphasis here, the recognition that energy has come into the play. Well, in this country at least, and it's not necessarily the same overseas, if it's good enough to get a market return, there are people already doing it, unless they've got some kind of governmental concession, like wind farms or solar. So one has to be very careful, I believe, but conceptually, this is a great asset class if you can get it, but attacking it, possibly one investment at a time, is better still, because it's going to be hard to populate this with assets you believe can get appropriate returns for the risk taken.
We'll take it.
Any other questions? Again, this was an introductory session, so we don't have any conclusions, just, so we'll talk to you, Joe, offline or online. Anybody else? Okay, great.
Thank you.
Thank you.
Thank you. Okay. I had wanted to wait for Martin, but since he's not here, we'll just... He's here. There's Martin.
Timing of an actor.
Wow, really? That's well done, Mark. So if everybody has their August report. Now, having just done September 4 days ago, nothing has changed in those last 4 days. So I'm not going to bore you with the markets and what went on in Europe and the U.S. and the election and all that stuff, as we said before. So I'm going to make this as brief as possible. So if you look on page 33, you sort of get to the punchline. As I said on Thursday, the first quarter's been good, so you can see the increase in value from 25.5 to 26 billion during the month of August. So I think we're at the all-time high for the police pension fund. Again, the asset mix hasn't changed either. We did it as I described yesterday. We put some money into bank loans and some 4+5 as we discussed. The only thing that is really different, if you will, is the actual results, which are on page 42. And again, August was a good month, so you can see on page 42 in the far left-hand column, we made 1.5% that month, and I think we made another 1+% in September. So as I said last week, we're up about 4 or 5% for the first quarter. All the markets were good in August, and then things got even better in the bulk of September after the Fed and the ECB made their announcements. So in order to be expedient, if anyone has any questions, we'll take them. Otherwise, we'll come back to you with the first quarter in about 3 weeks.
There's also some alpha in that last month.
Yeah, we like that.
Yes.
It's nice when things go as they're supposed to.
Yes.
And when things are calm and you can actually go about your business. So that's the month of
I have a quick question, Larry.
August. Yeah.
On page 38, where we show the asset allocation for the plan as well as the rebalancing ranges,
Yeah.
I noticed on the report that was provided last week, as well as this report, we seem to be underweight to tips at 2.1% versus our rebalancing range. The lower end of the rebalancing range is 4.6%.
Yes.
And so my first question is, what is our rebalancing policy? Because I would expect that if you're out of balance in a month, that you then need to go back to within range the following month.
Martin, do you want to first talk to the official policy?
Yeah, so what we've done and what the policy is to craft a plan to get back into policy. If you turn back, you can look at this page, which is chock full of numbers, but if you turn to the prior page, page 37, which has the picture, you'll notice on the left side of the page, virtually all of the equity policies are very, very close. A year ago and a few months ago, that wasn't quite the case. We are, as we're moving billions of dollars in total from the old to the new asset allocation, it does take some time. For TIPS in particular, the allocation was increased from 3 to 4%. But moreover, in the parking places, we had a new rule implemented which put approximately half of the uninvested real estate in there. So Xing out that parking place, we're about 1% underweight, and we expect soon to have that short covered. As far as the parking places, we'll be working on that as well. But you'll be seeing, over the coming months, that short covered. And it has to come from somewhere, so we're coming up with a plan to...
Right. But TIPS are a very liquid asset class. And so it should be quite easy to take money from either a contribution that's coming in to the plan or, an over-allocation to a certain area of equities and easily and quickly rectify the situation. So I'm speaking as a trustee of the board. One of our roles as a trustee is to ensure that staff is complying with the board's policy that we've set forth. And I'm just concerned that we were not alerted to the fact that we were outside of the policy, and this wasn't discussed at the last meeting, and that it is taking so long to get us back into policy, especially since at the last board meeting, we saw in the quarterly report that being away from policy has had a significant negative effect on the total portfolio.
So let me deal with a couple of aspersions you just made.
Yeah.
One, you've seen these numbers every month. So to say you hadn't seen it all of a sudden and you woke up one day and said, oh my gosh, we're under, I think these are in living color. So nothing has changed relative to TIPS. So to say you haven't seen it, I find that amazing.
No, I've seen it actually for the past 2 months.
Well, between the last month and this month was 5 days, but
Right.
you've seen it for months, right? It's been here for months. That's number one. Number two, I don't think the IPS says that each month you have to do it. You have to change the ranges, regardless of how liquid or illiquid it is. It's not written so in the IPS. The IPS gives you guidance as to the ranges, and it's our job to stay in the ranges.
Right.
Right, but it doesn't say each month.
Well, I guess I'm a little bit confused because typically a rebalancing policy does have a rule that says if you go outside the range, you need to get yourself back into the range by a certain period of time. Not that you can stay out of the range for 3 months or 6 months or a year. And so I'm just confused about what the actual rebalancing process is.
So 2 things. While it is true that TIPS have liquidity, I wouldn't classify them as the most liquid. While they are treasuries, they're not the most liquid. 1% would be $250 million, so it would take some time to do. It wouldn't happen overnight, but it would take some time, unlike regular treasuries. Secondly, the asset allocation, when it was adopted in July 7th of last year, the inputs from SIS were markedly different from what the inputs would be today, where the market has moved. We've been talking to our managers about moving the money, and we have been, as we've noted several times, that the managers have been telling us to hold off. Now, with the QE announcement recently, they've now told us, and we're having conversations with them as we speak, not right now, the second, of course, but we are therefore moving to cover that short, as I mentioned before, consistent with the expectations of managers and the board's policy. So we had been moving lots of money elsewhere. If you go back just a few months, the page looked more like this than like this, and this will be going away very soon. I can assure you of that.
But I'm still asking the question: what is the process? And if it's not defined, perhaps we do need to better define it, because again, I think the range is wide enough that there's plenty of room for market fluctuations, but we're at a halfway lower than the low end of the policy, and we've been there for 2 months. And so to me, that seems to be an issue, that either we need to better define what the process is for rebalancing, or better define how the period of time that the plan is allowed to stay out of balance. Because, as I said, I have a concern that we are underperforming our policy portfolio because of all of this slippage with regard to asset allocation.
Right, and part of that is the parking places, and part of it is the overall plan, and we always did have a plan to move into TIPS. It wasn't designed to be out of policy, and our interpretation of the IPS is that we would craft a plan that would get us back into policy, which we had. Much of that was looking at where the market is, looking at all the money that we have to move, consistent with benefit payments, moving other money, because to put money into TIPS, it has to come out of somewhere. So we want to coordinate it with other investments that we're making. And like I said, to allay your concerns, you will be seeing that light blue bar, unless we change the color, will be, you'll be seeing that shorter.
It'll go away.
And if I might just ask, part of our role as board members is to monitor the portfolio versus the policy and to understand where we're out of policy. And on a regular basis, we haven't been receiving any sort of compliance report with regard to where we are out of balance, either from a rebalancing range or other aspects of the policy in terms of compliance. Is that something that you are doing internally? Do you have compliance people internally who are looking at the board's policy and reporting back on areas of non-compliance?
That was that was the role of pages 38 to 39, where we show where we're in compliance and out of compliance, and what the
There are other
rules are.
aspects of the policy, guidelines, for example, not simply broad asset allocation and policy ranges. There are other aspects of the policy that are not being reported here, and I wonder if we need to have some additional reporting on a quarterly basis to alert the board as to where we're outside of the policy, and then what the performance effect of that would be.
What sort of, what were you thinking of?
A compliance report.
I'm unaware of what you're talking about. What would you mean?
Well,
I can tell you, since I've been here, there is no such report, so I'm curious as to what report you're looking for.
it would be a report that your compliance group would provide to you folks or to you as the CIO to talk about where there's slippage with regard to the policy. And I'm just realizing that as a board, we've never seen anything like that, and that ought to be something that we monitor on a semi-regular basis.
I know we have compliance reports with our managers that our compliance group monitors quarterly, correct?
That's right, yeah.
Quarterly.
For every manager, as you know, we have a set of guidelines, and those guidelines are potentially triggered at different points in time, and compliance is all over that, alerting to us, not only quarterly, but intra-quarter if there's something significant.
And we receive a certification from the managers with any exceptions noted or any issues in there noted.
In fact, we just audited our compliance relative to the, I think it was AICPA standards, and we were 99% compliant with everything that they wanted. So if you're looking for a report, show us what you'd like.
I'm looking for...
If the board is looking for a report,
it would be a report...
Otherwise, this is what we have.
It wouldn't be a report of them where the managers are out of compliance, because that would be something that you guys would monitor. We're looking for where BAM is out of compliance with the board's policy. So very similar to what you're receiving from your asset managers. Your managers have guidelines, and you get a report as to when they're out of policy. It would be, when is BAM out of policy with the board's guidelines?
Maybe you should show us what you'd like, if the board would like to see it.
This is the first I'm hearing of it.
It's the first I'm hearing of it, too, so that's why I'm a little, I just don't know what it is.
I'm just
you're trying to come
concerned
up with.
also, to the extent, I understand the policy mix can, stretch a little bit here and there, but I think that's why we allow BAM to determine as to when to actually pull the trigger on some of these assets, simply because there's a cost factor involved with that too, moving the assets back and forth. So if they want to delay a little bit in order to, wait for things to change, modify so that they can get back to the policy mix, that's why we give them the leeway to do those things. They're never hard and fast rules with regards to, obviously, if it's a 20% difference, there's a big issue there. We're talking a couple of percentage points in order to make the determination when to properly do it.
Right.
And I think monthly, we get this report, and maybe it's not said online, but offline, I might ask Martin why we open tips before the meeting or another time, and he'll say, well, the real estate's parked there and moving. So I think monthly, taking a look at this, to have BAM or somebody else make an effort of another report when we have it, monthly, right before the meetings, that we could just ask, very simply, we could tell we're out of compliance with tips, and he said, well, you're going to be fixed.
And we certainly welcome the inquiries as to the rationale, and we've been showing this, as Larry said, month by month for the past year.
And I think this is very good, and this is very useful, because we do need to look at this aspect of where we're at of compliance with policy, but I'm saying that there are other policies and guidelines that the board has put in place to manage the portfolio that I'm not sure we are monitoring on a monthly basis, like we're monitoring this one specific aspect of our policy. And so where BAM is doing a very good job of monitoring its managers' compliance with their policies, I think we as a board need to do a good job as well and ensure that we're monitoring compliance with all of the aspects of the board's policy, not just asset allocation and balancing. That's why I'm asking for something perhaps on a quarterly basis, just an exception report, either saying, no, there were no instances of policy violations, or there were instances of policy violations, here's what they were, and here's what we did to correct them.
Jen, if I may ask you, your ultimate goal is what? Chris, will the report tell us or help us enhance performance or mitigate losses during an out-of-balance period? Is that?
Yeah, it's to help us as a board monitor that the policy that we have put in place to manage the portfolio is being carried out. And if there are changes where it's not, we should be aware of it from a monitoring perspective. We should understand the implications.
Can you just give an example? I'm sorry, Joe. Just an example of another policy other than, since we're basically talking about this report. Is there another example, like a type of policy that they could be not compliant with?
Sure. So if we have, for example, a policy of having, and I don't know what the policy is because I don't have it in front of me, but let's say we've decided we want to be 50% passive in domestic equity and 50% active. That's our target. I don't know actually if we are 50% active and 50% passive. Maybe we're 80% active and 20% passive. I just don't know. So it's really just things throughout our investment policy that are measurable and monitored, and that we're able to monitor. And it occurs to me that we're not looking at all these aspects regularly.
Do you have an idea with regard to a possible report to this effect?
The first we've heard of it, we'll come up with something, we'll think about it. The board wants us to think about it. You know,
I think the ideal solution is it should be part of the quarterly performance reporting packet to highlight where you may be out of policy. I would also say that the plus or minus 1% around tips should be reviewed. It's too narrow. If you recall in May when I went through the capital market expectations, my advice was to get to the bottom of your ranges and anything south. Correct?
What did you say, and get to the bottom
Get
of
to
the
the
range?
bottom of the ranges of all your sovereign debt categories, which would include tips and nominals. And this doesn't leave you a lot of room to move on what a lot of people think is a good type of default. So I would do something in the quarterly monitoring report, and we'll review that plus or minus 1% around tips for the next meeting.
One of the things that we wanted to review also, and that we'll do for the next meeting, is the parking place for the real estate is 1.5 of that range. So I think it's, if you go to page 39, the TIPS policy target, you see there at the very bottom, it's 50% of the uninvested real estate, so 1.6% is added, is forced into TIPS because of parking place real estate.
The normal position is 4.
Right.
1.6 for the...
Which was an increase from the original 3.
Right. And again, if you were just to focus on TIPS again, just for some good historical perspective, if you go back to page 35, the old asset allocation, it was at the bottom end of the old asset allocation. Then we added a point to it, so that moved it up, and then you added 1.6 points for the parking place. But let's Barry, we'll talk to you about the tips.
Okay.
Okay? Anything else in August? Perfect. I think that ends the public session.
See a motion to go into executive?
Yes.
Motion to go into